The numbers don't lie, and they're brutal. Walk into any room of 100 people who've tried trading, and only 5 of them will still have money in their account a year later. The other 95? They're gone, wiped out, back to their day jobs with lighter wallets and heavier lessons. But here's what keeps me up at night. Those 5 people who made it aren't smarter than you. They don't have secret algorithms or insider connections. They're looking at the exact same charts, the same price movements, the same opportunities. So what do they see that you're missing? I've spent the last decade watching thousands of traders blow up their accounts, and I've noticed something strange. The advice that destroys most people is the exact same advice that's plastered all over social media. Buy low, sell high. Cut your losses. Let your winners run. Everyone knows these rules. Everyone repeats them, and everyone still loses. That's because knowing what to do and actually doing it live in completely different universes. Let me tell you about Sarah. She was a dentist, sharp as they come, made excellent money, respected in her field. She came to trading because she thought her analytical mind would give her an edge. First month, she made $2,000. Second month, $4,000. She was ecstatic. Her friends asked for tips. Her family was impressed. Month 3, she lost $11,000 in 8 days. She couldn't sleep, couldn't focus at work. Her hands shook when she opened her trading platform. Sarah had the same intelligence in month 3 that she had in month 1. What changed wasn't her brain. It was something nobody warned her about. The trading industry has created a massive lie, and you've probably fallen for it. They sell you courses on technical analysis, chart patterns, indicators, and strategies. They tell you that trading is a skill you can learn, like riding a bicycle. Master the patterns, understand the indicators, follow the rules, and you'll make money. It sounds logical. It sounds fair. It's also completely wrong. Think about this for a second. If trading success was really about learning patterns and following rules, then the most successful traders would be the ones who studied the most, who knew the most patterns, who had the most indicators on their screens. But that's not what we see. Some of the most profitable traders I know use strategies so simple it would bore you to tears. Meanwhile, traders with encyclopedic knowledge of every candlestick pattern ever discovered are going broke every single day. The real difference between the 5% and the 95% isn't in their heads. It's in their guts. Let me explain what I mean. Imagine you're in a trade right now. You bought a stock at $50, and it's currently at $52. You're up $2 per share, and you've got 100 shares. That's $200 profit. Not bad for a day's work. But then something happens. The price starts dropping. 51.50, 51, 50.50. Now you're barely breaking even. Your heart rate picks up. Your palms get sweaty. You tell yourself you'll sell if it hits 50, right where you bought it, because at least you won't lose money. It hits 50. But you don't sell. You think maybe it'll bounce. It drops to 49.50. Now you're down $50. You should definitely sell now, right? But that little voice in your head says something clever. It says if you sell now, the loss becomes real. If you just hold on, maybe it'll come back. It drops to 49, to 48. You're down $200 now. The same amount you were up just 20 minutes ago. Finally, in a panic, you sell at 47. You've lost $300, and you feel sick. Here's the kicker. The 5% who make it, they felt the exact same things. The same fear, the same hope, the same nausea. But they did something different with those feelings. And that difference is everything. Most people think emotions are the enemy of trading. You hear it all the time. Be disciplined. Don't let emotions control you. Trade like a robot. But you can't trade like a robot. because you're not a robot. You're a human being with millions of years of evolution wiring your brain to avoid losses and seek safety. When our ancestors were on the savannah, the ones who survived weren't the ones who took big risks. They were the ones who ran from danger and played it safe. That same wiring is still in your brain today, and it's absolutely terrible for trading. Your brain has a feature, not a bug, that makes you feel losses about 2.5 times more intensely than gains. Scientists call this loss aversion. It means losing $100 hurts way more than winning $100 feels good. In normal life, this keeps you safe. In trading, it destroys you. Because what does this mean in practice? It means you'll hold on to losing trades way too long hoping they'll turn around, and you'll cut winning trades way too early to lock in that good feeling. Let me give you a concrete example. Two traders, both following the exact same strategy. The strategy wins 60% of the time. When it wins, it makes an average of $100. When it loses an average of $100. Mathematically, this strategy should make money over time. 60 wins at $100 each is $6,000. 40 losses at $100 each is $4,000. Net profit of $2,000 over 100 trades. Simple math. Trader A executes the strategy perfectly, takes every signal, cuts losses at 100. Lets winners run to 100. After 100 trades, they're up exactly $2,000 like the math predicted. Trader B follows the same strategy, but with one tiny difference. When they're winning, they get nervous and take profits early at an average of $70 instead of 100. When they're losing, they hold on hoping for a reversal and end up losing an average of 130 instead of 100. Same strategy, same win rate, completely different results. Trader B now makes 60 wins at $70, which is $4,200. They take 40 losses at 130, which is $5,200. They're down $1,000 using a strategy that should have made them $2,000. That's a $3,000 difference caused purely by emotions, not by knowledge or skill or intelligence. This is why 95% fail. Not because they don't know what to do. Not because they lack information, but because they can't execute what they know when money is actually on the line and their nervous system is screaming at them. The 5% who make it have figured out something crucial. They've learned to build systems that account for their humanity instead of fighting it. They know they're going to feel fear. They know they're going to want to break their rules. So they create external structures that make it harder to sabotage themselves. One trader I know, made millions over his career, has a rule that sounds insane at first. He's not allowed to close a trade manually. Every single trade he enters has a predetermined exit point programmed in advance. Stop loss and take profit, set before he even enters. He can't override it. He physically removed that option from his process. Why? Because he knew that in the heat of the moment, when real money was moving, he couldn't trust himself to make good decisions. Another successful trader uses what she calls the 24-hour rule. If she wants to deviate from her trading plan in any way, she has to wait 24 hours before doing it. 99 times out of 100, the urge passes. The market moves on, and she realizes she was about to make an emotional decision disguised as a logical one. But there's something even deeper going on that separates the winners from the losers. It's about how they think about money itself. Most people who get into trading see each trade as a chance to make money. The 5% see each trade as a statistical event in a long series of statistical events. That might sound like a tiny semantic difference, but it changes everything. When you see a trade as a chance to make money, every outcome matters. Every win feels great. Every loss feels terrible. You're on an emotional roller coaster that's completely dependent on things you can't control. When you see trading as a statistical process, individual outcomes barely register. You expect to lose 40% of the time if your strategy wins 60%. You expect randomness. You expect variance. Your emotional response flattens out. Think about a casino. Does the casino freak out when someone wins $10,000 at the blackjack table? No, because they know that over thousands and thousands of hands, the math works in their favor. They have an edge, and they let it play out over volume. The 5% of traders who make it think like the casino. The 95% who fail think like the gamblers at the table, hoping this next hand is the big one. Here's another thing nobody tells you. The best traders lose money constantly. One of the most profitable hedge fund managers in history had a win rate below 50%. He lost money more often than he made it. But when he won big. When he lost small. He had the emotional discipline to cut losses fast and the patience to let winners develop. Most people have this exactly backward. There's also this myth that you need to predict the market to make money. You don't. You need to respond to the market. Big difference. Predicting means you think you know what's going to happen next. Responding means you have a plan for whatever does happen next. Predictors are constantly surprised and thrown off balance. Responders are ready for anything. I've seen traders with prediction accuracy of 40% make fortunes. I've seen traders with prediction accuracy of 70% go broke. The difference wasn't in being right or wrong. It was in what they did after they were proven right or wrong. The profitable ones cut their wrong ideas quickly and rode their right ideas patiently. The broke ones did the opposite. Let's talk about something uncomfortable. Most trading education is designed to take your money, not make you successful. Think about it from a business perspective. If someone actually had a method to print money from the markets, why would they sell it to you for $97? They wouldn't. They'd use it themselves, or charge institutional money millions for access. The trading course industry exists because selling hope is more profitable than trading. This doesn't mean all education is worthless. It means you need to be incredibly selective and skeptical. The 5% who make it usually spent time learning from people who actually trade with real money, not people who make their living selling courses. They learned principles, not predictions. They learned risk management, not hot stocks. They learned psychology, not patterns. Speaking of risk management, this is where most people reveal they're not serious about trading. Ask a failing trader about their risk management, and they'll give you vague answers. Ask a successful trader, and they'll tell you exactly what percentage of their account they risk per trade, what their maximum daily loss limit is, how much total exposure they allow themselves. They treat risk like an engineer treats load-bearing calculations. Precisely. Mathematically, without emotion, the standard advice is never risk more than 1 or 2% of your account on a single trade. Sounds boring, right? Most people ignore this because it means if you have a $10,000 account, you're only risking $100 or $200 per trade. That feels too small, too slow. They want bigger wins faster. So they risk 5%, 10%, sometimes 50% on what they think is a sure thing. And that's how accounts die. The math is brutal here. If you lose 50% of your account, you need to make 100% just to get back to break even. Lose 70%? You need to make 233% to recover. These aren't just numbers. They're psychological death sentences. Nobody comes back from a 70% drawdown with their confidence intact. The 5% who survive protect their capital like it's the most precious thing in the world. Because it is. Capital is your ability to participate, lose it, and the game's over. They'd rather make small, consistent gains over years than swing for home runs and strike out. There's also the uncomfortable truth about time. Most people expect to be profitable within months of starting trading. The reality? Most successful traders struggled for years before they figured it out. Years of losses, years of mistakes, years of learning what doesn't work. You wouldn't expect to become a surgeon after watching YouTube videos for 3 months. Trading is just as complex, but people treat it like a get-rich-quick scheme. The market is the most expensive school you'll ever attend, and tuition is paid in losses. The 5% accepted this. They treated their first few years as an education and budgeted accordingly. The 95% expected immediate success and gave up when reality hit. Let me tell you what finally clicks for people who make it. They stop fighting the market and start working with it. They stop trying to prove they're smart and start trying to survive. They realize that being consistently mediocre is infinitely better than being occasionally brilliant and frequently broke. They embrace boredom. They execute the same simple strategy over and over, even when it's not exciting. The market rewards patience and punishes impatience. It rewards discipline and punishes randomness. It rewards humility and punishes ego. Every loss you take is either a lesson or a tuition payment for a lesson you refused to learn the first time. The choice is yours. So why do 95% find trading impossible while 5% find it obvious? It's not about intelligence or education or access to information. It's about emotional regulation, risk management, and the ability to execute a plan when your brain is screaming at you to do something else. It's about treating trading as a business with systems and processes, not as gambling with extra steps. The good news? These are learnable skills. The bad news? Most people will never put in the work to learn them. They'll keep looking for the magic indicator, the perfect strategy, the hot stock tip that changes everything. And they'll keep losing. The 5% stopped looking for magic. They found discipline. And that made all the difference.